Hello and welcome back to my channel. Today on this Saturday, we are just going to talk about what has happened in the market, what steps we can take, and is there any reason for panicking? First of all, I'm a SEBI registered investment advisor. Declaration and disclaimer that this is not an intention of purchase of any securities of any type, and this is just an overview of the Indian market and the economy. So let's go straight. The market has been falling down, and this has created a lot of jitters among most of the investors. And let's see how the markets have fared over the last few months. Let's go to Nifty mainland indices. I'm using Grow. Again, disclaimer: I'm just using Grow because they have a good user interface, smooth and user interface. Now, this is something that I was talking last Tuesday. Let me just draw a horizontal line over here. I'm very poor at technical analysis of this chart things and all that. Let's look at this. Right. So the market back in September 2020, the market. This is the weekly charts, by the way. The market went up all the way, hit something around 15,000. Took some time to break up 15,000. Went down, took 15,000 as a great support. Went up 18,000. Well, and then we all started pumping in money, right? That's why we think that the prices of the stocks are going up. It went up 22,000 and hits 26,000 and then falls down. Let's look at the acceleration over here. We don't need any technical indicators, but the fall down over here, as you see, is pretty fast. So if you see over here, the fall downs are like, there are some red, on a weekly, week by week basis. We see a few red days, which is negative days, a couple of small dark green days, some sort of recovery. This is after a very long time. After a very, very long time, we are seeing a continuous fall in the market. So it's red, and again a deep red. Now we can expect a few green things to come over here, but my expectation is that this market is not going to go up 26,000 anytime soon unless there is a lot of positive news. So right now we are not seeing a lot of negative news. We are still seeing the war in Russia, Ukraine, the Gaza wars have always happened in the last 60 years or so. But we are not seeing anything news that is helpful in doubling the economy. Right? We want to become $7 trillion economy. Where is the manufacturing? What are we producing? Are our manufacturers doing large-scale manufacturing tasks? Is there land acquisition? Yeah, the roads are getting constructed. The tar is falling, but new roads are getting constructed. But where are those roads leading us to? That's a little concern. So a lot of people, I think, are pulling out money from the market, especially the FIIs. And it just can't be the pullout of FIIs. There has to be some sort of pullout of the DII money also from some of the key stocks that may be holding large quantities in the stocks that matter. So Nifty, yes, I don't expect Nifty to fall down all the way to 15 at least as of now, unless something disastrous happens. But we can look for probably 6 months, again, I'm telling you, probably 6 months of range-bound market. That is, we could expect markets come down all the way to 22 and then go again back to 26,000. That's the way I see, unless the next budget comes out very positive, helping corporates, bringing in more money, some sort of tax benefits, etc. We are also very much dependent on the US elections, the outcome of US elections. So don't expect anything pretty soon. Also, for those who in the last 1 or 2 years who have become stock market experts by looking into PE ratio and some other numbers, you want to have a ratio, you can take a numerator, take a denominator, divide it, you get a number. But let's understand that those numbers are all from balance sheets, and the stock prices just can't keep doubling because you are putting your SIP money. Let's understand this, that there are other factors like FII is pulling out, so they are selling. And if you sell, then the matching price is what the buyers take. So it's not that I'm putting money in the market, so therefore I can rescue the Indian stock market because I'm putting my 10, 15,000 rupees SIP. Yes, it helps. but the money is increasing the stock price. It doesn't go into actually into the company. So uh, so don't expect that because the Indian household start putting money into the market, the economy overall will increase. Yes, the company's ground level performance has to increase, the company sales has to increase, companies have to optimize their operations, Indian companies have to innovate and have to bring in newer products at possibly better prices that the customers can buy, and therefore the money has to rotate in the economy, right? So just pumping in all your money into the equity market and expecting that the stocks prices will just go up doesn't happen. So this is about Nifty. Let's take a look at where's midcap. This is Nifty midcap. Yeah, Nifty midcap select. So let's look at Nifty midcap select. We have data only from 2022, but that's fine. Let's take this. Let's put in some lines, right? The one reason why people love these charts and all is you can put a lot of lines just for our visual appeal, but it also gives us some sort of an expectation of what happens. Okay, so yes, 2023 the markets, especially mid caps, were pretty low, and then mid cap had probably the best run in its life. 2023 to 2024, we have had around 120, 130% rise. And if you see mid caps, the mid caps have started falling much, much more than what we saw in the large caps. You see over here, there were some green shoots over here, but this big red candle, that is a fall in the price, is perhaps what it took to create from this previous level, that is from July 22nd to the top of from where it fell. It took something around, say, July to September, and that's all the value has been just erased in a single day. So we're looking at a pretty big fall, and we haven't, at least in Grow is not showing anything before 2022. Probably the worst fall would have been during COVID times. But this is probably one of the big falls. We can expect again a few green candles here and there, but from the mid cap point of view, we have had a tremendous run up. We have a tremendous run up. We should expect a negative bias or a negative consolidation in the mid cap segment. So let's see. What's happening to the market is that the markets definitely are falling. It's very much in our face. So what should we do? So if you, again, my suggestion is that if you have made money in some of those stocks accidentally by looking into some P ratio and doing some 6 standard ratio mathematics, and or because of coincidence of this bull run that people have become all financial experts. So if you have made some money in the market, my suggestion is that exit some of those stocks, especially the small caps and some of the mid caps. We don't know how the market is going to react. It's good to be a little bit cash light. Don't catch falling daggers is what is often said in the financial world. So we don't know what's happening. We want to see a lot more economic reforms within India and also across the world. China is taking some part of the money from the world, but that doesn't mean that China will continue to take all the money. There may be other countries that might create better economic policies for manufacturing basis. So it's not just that I'm telling that your long-term goals, if you had contacted a semi-registered investment advisor, would usually take a 10% or 12% range for your equity investments. And if the equities rise 100%, obviously for a long-term 12%, you should be seeing a few years in negative. Right. So nothing to worry as of now from the Indian economic point of view. We are not going to collapse like countries like Pakistan, but a word of caution that do not get into the recency bias of getting 100%, 200% returns in some of the small and the mid cap stocks, and therefore take this opportunity and you expect the market to go up. No, that is certainly not going to happen unless there is a lot of positive news in the Indian economy. Thank you for watching.